What is the US trade deficit with China? Have you ever wondered how trade between the United States and China affects the economy? The US trade deficit with China is a key part of this story. It refers to the situation where the value of goods imported from China exceeds the value of goods exported to China. This imbalance is significant and has been a topic of discussion for many years. As of early 2025, the US trade deficit with China is substantial. In 2024, the deficit reached approximately $295 billion. This means the US imported $295 billion more in goods than it exported to China. While the US does export services to China, which generated a surplus of about $32 billion, it is not enough to cover the goods deficit. In January 2025 alone, the US imported goods worth about $41.6 billion from China, while exports were only about $9.9 billion. This resulted in a monthly deficit of roughly $31.7 billion. February saw a deficit of about $21.2 billion. By April 2025, the trade deficit was around $19.7 billion. From China's viewpoint, this trade imbalance contributes to its large trade surplus. In the first 5 months of 2025, China recorded a total trade surplus of about $472 billion. A significant portion of this surplus comes from trade with the US. China's exports to the US have steadily increased over the years, although there have been ups and downs due to tariffs and trade policies. This trade deficit is a natural result of capitalism, where market forces dictate trade flows. The US imports many manufactured goods and electronics from China, where production costs are often lower. Meanwhile, the US exports services and some goods, but the volume does not match the scale of imports. Government regulation and trade policy also play a role in shaping this deficit. Tariffs and trade restrictions can influence the flow of goods. While they may reduce imports, they can also raise costs for consumers and businesses. Capitalism promotes open markets and competition, which can lead to lower prices and innovation, despite existing trade imbalances. In practical terms, the US trade deficit with China means American consumers often enjoy lower-priced goods. However, some domestic industries face competition from these imports. Policymakers must balance these outcomes by considering economic growth, employment, and the broader impacts of trade policies. The US trade deficit with China is a large and ongoing issue, currently in the hundreds of billions of dollars annually. It reflects the dynamics of international trade under capitalism, shaped by production efficiencies, consumer demand, and government policies. Understanding this trade relationship is essential for grasping the bigger picture of global economics.